Joining me to wrap up the week, Ron Insana, CEO of Insana Information Partners. He joins me at the desk. Ron, great to have you.
It's great to see you. Thanks for having me, Caroline.
All right, so what do we need to take away from this week? What do investors actually need to care about right now?
Well, I think they still have to care about the data fog that we're going through. I mean, we've got CPI, or consumer price information, that told us inflation was a little better than we thought, but the data were wildly incomplete because there was nothing from October. We got the unemployment report, which again also to a certain extent was somewhat incomplete and somewhat confusing. So we don't know exactly where the economy is right now. We think the labor market's weakening. We don't know whether inflation is actually coming down in a meaningful way. So I think those questions remain open as we move into the remainder of this year and on into 2026. And then there are huge questions around the viability of all this AI infrastructure spend and whether or not only can it be maintained, but can it ultimately be financed? And will there be enough profitability among all these major companies in the tech sector to pay down the debt that they're increasingly using to build out data centers, buy software, and buy chips?
So heading into year end with some uncertainty still,
Yeah.
although quite a bit of optimism today. We're
Yeah.
seeing some follow through from yesterday's gains today. Do you think that we're setting the stage for the Santa Claus rally to come next week?
I don't know. I'm not a huge fan of some of those indicators. I mean, they come around because people are, kind of squaring their books at the end of the year, and they might mark up stuff that they already own to make the year end look better. So I think that's, to a certain extent, it's meaningful if you're a trader. It's not terribly meaningful if you're an investor. There are reasons to think the market might go higher still. We're probably betting that the Federal Reserve will cut interest rates again sometime early in 2026. That's a benefit to the markets almost always. And so I think, there's no reason to be wildly fearful at the moment. But I'm looking ahead beyond the end of this year. I'm getting a little bit more cautious about 2026.
And what does that look like in terms of portfolio positioning? What would a cautious about 2026 portfolio look like?
I mean, I am not a fan of diversification, but I think will become increasingly important over time. I'm not convinced that the U.S. will be or continue to be the best place to be overweight your investments. I think, there are questions around the independence of the Fed, whether or not the next Fed chair lowers interest rates for political rather than economic reasons. So far this year, overseas markets have wildly outperformed the United States, whether it's developed markets in Europe, whether it's Asia, or whether it's emerging market equity and debt markets in local currency terms. So they've all outperformed the United States, in some cases by more than 2 times. So I think that deserves a look next year, particularly if the dollar were to weaken and rates were to come down and we start running into problems of either a weaker labor market or higher inflation. I think one has to kind of really relook at the balance in your portfolio to determine if you have enough exposure offshore.
So you think international will continue to outperform next year?
I kind of do in specific instances. I mean, I'm not quite as sure about Europe next year as I was this year. They're spending a lot on defense and infrastructure. They're doing more of that than they have in quite a long time. Certain parts of Asia, which ripped this year, like South Korea was up close to 50-60%. They're becoming beneficiaries in this very strange way of China selling inexpensive goods throughout Asia and the global south. So I'd be keeping an eye on all those markets, particularly if the dollar comes down. That's a real benefit to U.S. investors because the profits, when they bring them back home against a weaker dollar, are amplified. And so it gives you an opportunity for not only price appreciation, but then positive translation on the currency front.
Where in the U.S. still looks attractive to you right now? And you have to ask, you talk about the potential for an AI bubble. Do you still need to be invested there in 2026?
I think you have to selectively so. I think you have to be really careful with the companies that are taking on enormous amounts of debt to finance the infrastructure build out that's going on. You look at some of the credit default swaps on big brand name companies that have been rising exponentially in recent weeks, which shows that some investors are really concerned about the sustainability of this. And so I'd be a little more careful given the expensive nature of some of these stocks, and look more at those that would benefit from the implementation of artificial intelligence as opposed to the hyperscalers or some of the others who are building it out.
Which would be what?
Some of them have yet to come public, right? So, I mean, you've got I believe it is 1,000 companies worth $100 million in the private market. You've got 500 that are worth $1 billion. So I would expect that we'll see an onslaught of applied AI companies coming public next year, that if they do have a good business proposition that enhances productivity and also increases efficiencies, for any company that uses their service, that's probably a great place to look, although it's early. We'll have to wait and see what the IPO calendar looks like on that front next year.
Do you expect the IPO market to boom next year? Because there is a lot in the pipeline.
Yeah, I mean, it's certainly going to pick up, and if you look at venture capital firms, they're looking for exits after having put a lot of money to work in the space over the last several years. If market conditions are favorable, yeah, I think the IPO calendar will boom. Otherwise, it will be selective, and you'll see, the strongest names come out and probably perform reasonably well in this market. I do think, though, overall, it's a really expensive market that may have more than one risk associated with it in 2026.
What's the biggest risk?
I would put Fed independence first. I would put geopolitical risk second, particularly if something like a war in Venezuela takes place. That would upset the oil markets. That could create economic dislocations. And third, there's some political risk. I mean, you could see a change of control in the House next year, and then you could see President Trump becoming, truly in many ways a lame duck for the next, couple of years, which isn't always bad for the market.
Sure.
But there wouldn't necessarily be any further stimulus beyond what's already been offered. And so then I think at that point, when you put all those things together and the historic overvaluations that we're seeing in a lot of sectors of the market, there's a risk of a meaningful correction sometime next year.
I'm sensing quite a bit of caution
Yeah,
as you head
I think
into
that's safe,
looking
yeah.
outside the U.S.,
Yeah.
talking about the potential for an AI bubble, talking about all of the risks. Can you make the case that this is a market that can move higher, though, from here?
You can make the opposite case. So the way in which one could do that is, all right, there's going to be some additional stimulus for individuals, and it's not $2,000 checks coming from the federal government, larger tax refunds that will come as a consequence of the One Big Beautiful Bill, lower interest rates, housing prices coming down, which may open the door to buyers getting back into real estate and being able to afford a portion of the American dream. And then beyond that, if the AI infrastructure build out continues and the top 20% of American wage earners continue to spend the way they're spending now, you could make the case for a strong economy, or reasonably strong economy, and a continued bull market. Having said that, though, as you mentioned, the reason I'm cautious is that every single indicator that we look at shows a high degree of overvaluation for the market writ large. So, against that backdrop, I'd be careful. The other risk, I think, is if the Fed cuts and then inflation reaccelerates, they would have to reverse course. And that would be the thing that would pop the bubble if indeed something like that were going to happen.
Would that be your base case?
No, I don't. Base case is hard, right? I mean, say the bubble's going to burst, right? Anybody who
but that inflation will reaccelerate, because we are seeing signs from gold and silver say they've had a really strong year.
Yeah, gold, silver, and I don't pay as much attention with respect to inflation on crypto as other people do. But if the dollar comes down a lot, inflation is going to go up. Gold and silver will go up more. And then, the Fed might start looking at that message of those markets and say, okay, maybe we did a little too much. Maybe inflation is going to reaccelerate. It'll depend on whether or not the tariffs get taken off or are left on. And they could have to reverse course at some point next year. And so, not a base case, but I think it's a risk that's meaningful.
Okay, so just as we wrap things up, best advice for investors, given that there are quite a few things to be concerned about.
I would say if you're overexposed to these areas that have done extraordinarily well this year, particularly given the concentration of the big AI stocks in the S&P 500, it's always prudent to, take some chips off the table, both literally and figuratively in the case of artificial intelligence, and rebalance that portfolio so you're not overexposed to either any single stock or any single group. And then look for some diversification options, potentially outside the United States and developed Europe and emerging markets.
All right, we'll leave it there. Ron, really appreciate you joining us. Thanks so much.
It's a pleasure.
That's Ron Insana of Insana Information Partners.